Germany was supposed to be the safe one. The country of precision-engineered cars, world-class machinery. Made in Germany, quality that ranks first in many global made-in-country indices and balanced budgets that quietly held Europe together while everyone else lurched from crisis to crisis. Yet right now, that same Germany is being called the sick man of Europe again. IMF has cut its growth projections. Its economy has barely grown since 2020. It's sliding into a third straight year of recession. More than 3 million people are out of work. Volkswagen is talking about closing factories at home for the first time in almost a decade. And Berlin has just launched a 500 billion euro gamble that could either save its model or break it. This is still the world's third largest economy, just behind the US and China, and the most powerful member of the European Union, which makes this downturn especially alarming. So how did a country that once looked unshakable end up here? And can this giant spending plan really turn things around? After World War II, the country was in ruins, cities bombed out, industry destroyed, currency worthless. US-led Marshall Plan and social market economy model helped to reform its economy. Industries like automobiles, machinery, chemicals, and engineering exploded in scale, powered by a skilled industrial workforce and a culture that prized precision and reliability. Through the 1950s, West Germany grew at close to 8% per year, as trade barriers fell and supply chains stretched across continents. Each country leaned into what economists call comparative advantage. China built huge low-cost factories and became the world's hub for cheap mass manufacturing. Singapore specialized in finance, logistics, and refueling as one of the world's busiest ports. On the other side, Germany made the high-end, high-precision products where even tiny mistakes are unacceptable. That strategy turned Germany into the Exportweltmeister, the world's export champion. Exports made up about 42% of German GDP, the highest share among major economies. Roughly 1 in every 10 manufactured goods in the world came from Germany, and the country accounted for over 25% of Europe's total manufacturing output. Cars and vehicle were the most visible symbol of this strength. Brands like Volkswagen, BMW, Mercedes, Siemens, and BASF became global shorthand for German engineering. Take Wolfsburg, world's largest car factory, employing more than 60,000 people and producing nearly 1 million vehicles annually. That single factory alone builds more cars each year than the entire UK or Italy combined. Around 19% of German workers were, and still are, employed in manufacturing, more than double the share in many other rich countries. Rather than competing on low wages, Germany competed with automation and skills. Its factories relied on advanced machinery and highly trained operators, so each worker could produce so much value that high wages barely moved the final price. Between 2010 and 2019, this model delivered nearly 25% GDP growth, outpacing Europe, unemployment below 5%, and annual trade surpluses above $200 billion, more than any other nation on Earth. But there was a catch. That success leaned heavily on 3 external pillars: China as a customer, Russia as an energy supplier, and a global trading system that seemed stable and rules-based. But the latest trends depicts Germany once got rich on exports and cheap Russian gas is in trouble, and Germany's days as an industrial superpower are coming to an end. What happened? Initially, China imported German machines, chemicals, and high-end equipment to scale up their own production. As the Chinese consumers got richer, they fell in love with German brands. At one point, Volkswagen, BMW, and Mercedes earned roughly 40% of their global sales in China alone. This was great business as long as China kept buying and wasn't competing in the same high-value segments. But China's industrial base did not stay stuck at the low end of the value chain. It climbed upward, building its own advanced machinery, scaling a huge chemical industry, and pushing into sectors that Germany once dominated. The clearest example is cars. The future of that industry is electric. By 2024, China was exporting roughly 2.2 million electric cars a year, while Germany was shipping only 786,000, less than half China's volume. Around 40% of those Chinese EVs went directly into the European Union, undercutting German brands on their home turf. China is now outproducing Germany in machinery and pharmaceuticals as well. Germany's industrial production fell about 4.5% in 2024, while China's industrial output grew roughly 5.8% in the same year. Overall, German industrial output is down roughly 9% compared to 2018, an enormous slide for a country so reliant on industry. Even car production dropped nearly a quarter. Sales to German cars abroad fell to levels unseen since the financial crisis. The pain became impossible to ignore in 2024, when Volkswagen Germany's industrial crown jewel announced plans to close domestic factories with excess capacity of about 500,000 vehicles, roughly equal to 2 entire factories. Nearly 100,000 workers went on strike, and after intense negotiations, the union accepted a deal to cut roughly 35,000 jobs and save billions of euros over the coming years. At the same time, more BMWs were being built in China than in Germany, and across sector after sector, China was quietly moving from customer to direct rival. On energy side, after Fukushima disaster in 2011, it accelerated the shutdown of its nuclear plants. Plan was to buy cheap Russian gas, phase out nuclear, and push renewables regardless of cost. But in practice, the gap was bridged with cheap Russian gas. More than 55% of Germany's natural gas came from Russia. That strategy worked while gas was cheap and geopolitics were calm. When Russia invaded Ukraine, that assumption collapsed overnight. Russia cut flows through pipelines. Key infrastructure like Nord Stream was destroyed or shut, and within weeks Russian gas imports to Germany plunged by around 90% and erased another 20 billion euros in exports to Russia. By 2022, German natural gas prices were nearly 1,000% higher than in 2020. Average power prices jumped roughly 35%. Even though gas only made up roughly 15% of electricity generation, many heavy industries, especially chemicals, metals, and glass, used it directly as a production input. As prices exploded, factories shut down not because there was no demand, but because keeping the lights on was no longer profitable. Energy-intensive sectors shrank by about 10% in 2023, the sharpest industrial decline in modern German history. BASF, the world's largest chemical company, saw its energy costs shoot up by around 3.2 billion euros in a single year. It responded by cutting 500 million euros in costs at its main German plant, reducing output of key chemical products, and investing nearly 10 billion euros in a new chemical complex in China instead of in Germany. By 2022, nuclear power was fully phased out, but the renewables meant to replace it were not yet fully in place. Germany had effectively boxed itself into a corner, a highly industrial economy relying on imported fuel it did not control, just as that fuel became a geopolitical weapon. By 2024, these lead to cumulative damage. Since 2020, Germany's economy has barely grown at all. During COVID, exports fell about 10% within months, wiping out over 100 billion euros in trade income. By the end of 2024, GDP shrank by roughly 5%, more than $200 billion, its worst post-war performance. The country has been in recession for more than 2 straight years. All of this landed on top of a demographic reality that was already working against Germany. The country has one of the lowest birth rates in the developed world, around 1.35 children per woman, and it is aging rapidly. By 2030, nearly 1 in 4 Germans will be 67 or older, while the working-age population is shrinking by 300,000 to 400,000 people every year. That decline is already visible in the labor market. Germany faces more than 750,000 unfilled vacancies in key industries. Part of this comes from generous retirement pathways, which encourage earlier exits from the workforce. But another part is structural. Germany has struggled to attract and integrate skilled migrants at the scale seen in other advanced economies. At the same time, household finances have been under pressure. Since 2020, real wages in Germany have fallen by roughly 2%, while the OECD average has risen by about 1.5%. In real terms, consumer spending has barely grown since 2015. So when exports weakened and energy costs surged, domestic demand failed to step in. Instead of acting as a shock absorber, consumption remained cautious and subdued. For a country so heavily dependent on exports, all these combination is especially toxic. For a long time, Germany was the economy that bounced back fastest from crises. Now, it was the one lagging near the bottom of the European league table. In a standard macroeconomic playbook, this is the point where the government would step in aggressively, cut taxes, pour money into infrastructure, support strategic industries, and borrow heavily if needed. But Germany had written itself into a much tighter script. Germany locked fiscal discipline into its constitution with a debt brake in 2009. The idea was simple: commit to long-term discipline and avoid the debt problems seen elsewhere in Europe. This rule capped the structural federal deficit at just 0.35% of GDP and made it extremely hard to run the deficits that other big economies used to fight COVID and its aftermath. As a result, while the US spent over $5 trillion during the pandemic and other European countries loosened their strings, Germany held back. Germany lost its ability to invest strategically and attract foreign investments. One consequence was years of underinvestment. It's worth noting that despite its reputation, Germany has historically invested much less in infrastructure than other developed nations. Today, more than 36% of German bridges need urgent repair, and only about 30% of the country has access to decent broadband, less than half the EU average. For an export-driven, logistics-heavy economy, a crumbling supply chain and patchy digital network are serious handicaps. At the same time, the tax burden is heavy. The average employment tax wedge is around 48% versus about 35% in the OECD. Corporate taxes sit near 30%, compared with around 23.8% across the OECD, and capital gains are taxed at roughly 26.4%, higher even than top US rates. And then there is the bureaucracy. Starting a business in Germany can take more than a month, while in the US it often takes days. Permits for wind farms can drag on for 5 to 6 years. In Texas or China, similar projects can be approved in under 1 year. This culture has deep roots in Prussian administration and a better safe than sorry mindset that prioritizes risk avoidance over speed, which makes Germany unattractive for entrepreneurs and capital investments. In good times, that felt like stability. In bad times, it looks a lot like paralysis. Economic stress rarely stays confined to charts and spreadsheets. It spills over into politics and everyday life. In November 2024, Germany's coalition government collapsed under the weight of stagnant growth, falling real wages, immigration pressures, and rising public anxiety about the future. Against that backdrop, in March 2025, Berlin effectively loosened the debt brake and launched the largest spending package of 500 billion euros in German history, about 15% of GDP, with two main goals: fix the country's crumbling infrastructure and rebuild its energy system. Roughly 300 billion euros is earmarked for infrastructure. That includes expanding high-speed rail, so factories in Munich can coordinate more easily with suppliers in Frankfurt or Hamburg, repairing or replacing bridges, and finally rolling out broadband, so the country having decent connectivity stops being an embarrassment. About 100 billion euros flows into the Climate and Transformation Fund. This will pay for massive offshore wind farms in the North Sea, expected to produce about 6 terawatt-hours of electricity a year, enough for roughly 1.6 million households, and for a push to increase solar capacity about 5-fold by 2030. The idea is straightforward. Cheaper, more reliable domestic energy plus better logistics should help German industries stay competitive even without cheap Russian gas. Model projections suggest this scale of spending could push Germany back into positive growth within 2 years, create more than 1 million jobs, and stabilize tax revenues over time by broadening the economic base. Thanks to decades of strict fiscal policy, Germany still has one of the lowest debt-to-GDP ratios in the developed world. so in theory there is room to borrow. But the risks are real. Germany isn't just another economy in the Eurozone. It is the financial anchor. Investors are willing to lend to other European nations partly because they assume Germany will always be there in a crisis. German central bank estimates that servicing new debt could cost around 40 billion euros a year, about 8% of federal budget. If interest rates rise by just 2 percentage points, annual debt service could jump by another 25 to 30 billion euros at a time when bond yields are already near 40-year highs. Credit rating agencies have warned about possible downgrades if this spending is misallocated or if growth fails to materialize. Investors have already started trimming their German bond exposure. Without this package, unemployment could exceed 5 million by 2026, with growth still negative, leaving Germany too weak to support Europe at all. Germany is betting that growth will recover fast enough to keep markets confident. In other words, Germany is trying to correct decades of imbalance in one huge push while hoping it doesn't damage the credibility that allowed it to lead Europe for so long. That is why what happens next in Germany matters far beyond Berlin. Now Germany is running a real-time experiment. The question is whether a rich, aging, heavily industrial economy can use a wave of state-led investment to reinvent itself without losing the credibility that made it strong in the first place. If the projects are delivered on time and on budget, and if industry adapts, Germany could exit this decade with slightly slower headline growth, but a more resilient, diversified, and sustainable economic base. If that doesn't happen, if delays, cost overruns, and political infighting dominate, the country risks ending up with higher debt, persistent stagnation, rising populism, and a broken reputation. In that scenario, Germany is no longer the boring, reliable anchor of Europe, but a warning about what happens when a successful model waits too long to change.